What's going on, folks? Welcome back to the channel. In today's video, we're doing a comprehensive analysis on Kroger. Now, they just recently reported their earnings today. They beat their earnings, so the stock price is up about 3 or 4%. We're going to dive deep into the numbers of this business, figure out what they're doing right, what they're doing wrong, and then figure out the intrinsic value of this company so you know if you're buying this company, if you're getting it for a good deal or not. So without further ado, let's jump into it. And I apologize if I sound a little bit congested. I'm fighting for my life. Allergies are absolutely kicking my ass. Without further ado, let's go into the stock spec software and talk about this business. So here's the stock spec software. The software I like to use to analyze companies effectively and efficiently. So I have the Kroger profile pulled up here, taking a look at 3 different categories, one being the company metrics that's on the left-hand side, second being the financial valuations. And these two kind of work in conjunction with one another because they look at the financial health of the business over the last 5 years to current trends, and it compares it to the trailing 12 months. It works well with one another. Then last but not least, we'll take a look at the price analysis section. Here's where we do an assumption of what we think the company is going to do over 1 to 20 years. I like to do 10 right in the middle and forecast that back to figure out what we should be paying for the company today. So with Kroger on the financial valuations, we're ranking this company a 5 out of 10. It's not a decent score, folks. So we'll go over the bad and then we'll go over the good. The bad is simply this. Their current ratio is sitting below 1.5 where we want to see that. Currently is at 0.77, and that indicates to us that they have a little bit more liabilities on hand than assets. So ideally, we want to have that ratio of 1.5 and higher. That indicates to us that they have enough assets on hand to cover those liabilities. And currently, they're not in a decent spot in regards to that one ratio. But it looks like the trend going forward is that they also have a decently high debt to equity ratio, sitting at 200%. That means their financial leverage and how they compose themselves and do business is by taking on debt rather than fueling in equity. So equity is obviously much more cheaper to funnel in and considerably, I think it's much more efficient rather than taking on debt, especially now in a high interest climate where now the interest that you're paying on the debt is a lot more. So it being at 200% is not good. We like to find companies that have at least a debt to equity of 50% and lower. The lower the better, because we want to find companies that are fueling their operations through equity. Now, couple that with another negative point on the board being their share dilution. Kroger unfortunately has raised the amount of shares outstanding by 7% over the last 5 years. So if you've been holding this company for 5 years, folks, you've actually lost ownership if you believe that. The net income is also down over the last 5 years, and the return on invested capital is sitting at 7%. It's not the worst. Ultimately, we want to find companies that have around, above 9 or 10% on return on invested capital, depending on what your, your tolerance is. I like to go for above 10%. So those are the points where they're getting deducted. Now, here is the positives with Kroger. So we went over the negatives. I think that of the 10 categories that I went through, or the 5 things that are wrong, definitely the share dilution and the debt to equity is the biggest red flag. The net income, that could have just been we'll dive deep into that, but this share dilution and this debt is a major problem considering the fact that we are in a high interest scenario right now in this economy. Now, the positives with Kroger, let's take a look at that. One is their price to earnings ratio. So Kroger's price to earnings ratio is sitting pretty low. It's sitting at 13.23. We want to find companies that are below 22.5. So that indicates to us that Kroger might be trading in a fair value, if not an undervalued territory. Now, that's just based off the one metric. Also, something to consider that this is a consumer defensive company. It's in that sector. And essentially what that means is regardless of the cycle of the market, whether it's a bear or a bull market, consumer defensive markets usually do fairly well because they're pretty consistent because, look, it's a grocery store. People are going to buy groceries whether it's a recession or not. So if you're a conservative investor, this might be something to take a look into. Now, couple that with a return on equity average sitting at 25.21 that's decently high. We'd like to see something like that, and we want to find a trend where the companies have a decently high return on equity on average, and that is where Kroger is at. Also, the EPS growth is up over the last 5 years, sitting at 181%. So if you're holding this company, that is one positive to see, that they're bringing in more earnings per share. That exists. However, I think it gets nulled out because of the share dilution. And their free cash flow is up over the last 5 years along with revenue growth. So this is definitely a company. I want to take a look at their net income and see what's going on. What's the full story here? Let's go on an annual basis just to see what's happening. Okay, so 2019 we were at 3 billion, dropped for 2020. It started climbing back up. And now, okay, so we're down a little bit. We're down from 3 billion down to 2.25 billion. Now, is that just because the economy is in rough shape? Probably. People are not spending as much. Inflation is at an all-time high. Probably. That means they're not making as much money because people are not spending as much on food. That would be my first assumption. Now, back to the stock specs page. I just want to figure out that one mystery of the net income of why that's down. Now, here's the thing about Kroger. They do issue a dividend, and that dividend gets paid out. Let's see, it's 2.26%. Okay. So that works out to be, what, $682 million. That's indicated here at the company metrics. Not bad, considering that the free cash flow on average is $2.3 billion, and the trailing 12 months is $6.77 billion. Okay, so here's what it's kind of clicking in my head. This is a company that I think if you are a dividend investor and you're looking to just own this straight for the dividend, it's consumer, it's a defensive company, it's a grocery store, it has a solid dividend that can be easily paid out because they have enough cash on hand to pay out that dividend. This might be something you might want to hold if you're not too crazy about appreciation. It looks like right now, like just based off where the stock price, it's been trading sideways for the last several years. It spiked. Where did it spike? 2022. Hit a high of $52, now $41.82, now almost, it's at $47. Okay, so it kind of wants to exist in that $40 to $50 price range. That's where I think it wants to be at, considering everything that's going on. Now, so the one thing that, as I said, that kind of just speaks out to me is, if you're going to own this company, it's because you want the dividend. Now, let's see what we should be paying for that company today. And if you're enjoying the video, folks, hit that like button and subscribe button. It means a lot to me. It means a lot to the channel. So, in the price analysis, and if you want to get your hands on this software, folks, follow the links in the description box below. 7-day free trial. You'll love this next part right here. So, price analysis, I'm taking a look at the revenue growth, the profit margin, the free cash flow margin, the price to free cash flow, PE ratio, and my desired return. And essentially what I'm doing is 3 different estimations, and I'm putting in what I think this company will do over the next 10 years. And I am going to stay as decently conservative as possible, and I'm going to really pay attention to this conservative moderate amount. And I'm playing with numbers that are on the historic basis. And here's the thing, folks. Obviously, past performance is not indicative of future performance. Obviously, giving ourselves the most margin of safety is of the utmost importance, because that will dictate, well, how safe we are, and I guess, and hopefully we're not terribly wrong. So, that being said, I'm going to click calculate, and while this is crunching out all the numbers here, the current price is $47.35. I put my revenue growth numbers at 5, 6, and 7% based off these numbers here, off the 1 year, because it seems that revenue growth is going back up at an aggressive rate. And I'm going to put the profit margin pretty much what we've shown historically, same with the free cash flow, and a very heavily conservative price to free cash flow and PE ratio. Now, based off of those numbers alone, our average calculations comes out to be $33.32. That's on our moderate. And on our aggressive side, if you believe the aggressive average, this comes out to be $47.70 here. Now, in the aggressive category, we're pretty much almost there, and the DCF calculation comes out to be $43.50, sitting at 46. So maybe if you believe these aggressive numbers, maybe it's somewhere in this price range. Because here's the thing, folks, this net income, I hope it goes up. They beat the earnings. So if this goes up over the next little while, that's going to be great. However, I do have a problem with the state of the economy and inflation being as high as it is, if that's going to affect everything else going forward. Because here's the thing, folks. As inflation gets higher, as people's means of spending money becomes lower, they're probably not going to spend as much at the grocery store. Now, it doesn't mean that they're going to be obviously writing off grocery stores altogether. As I said earlier, this is a company that will probably be able to weather recessions, and it's proven to be a recession-proof business. However, you have to also keep in mind that what we pay for this company is the most important. So if you're overpaying for those earnings, yes, the earnings went up. Yes, the stock price went up. However, what do the next 10 years look like? So, and I would start with, what does the next year and a half look like, considering the state of the economy right now? So that being said, average calculation comes out to be $33. If this stock price hits that point, that is a place for me to eventually take a look at this business. However, if you are a dividend investor and you don't really care about the intrinsic value of businesses, then based off the metrics that I've shown you prior, this is a pretty safe business to possibly park your money, based off the fact that they're pretty resilient, they're able to pay the dividends, and if the price goes lower and you really only care about the dividend income, it makes sense to just buy on the way down, dollar cost average, collect your dividend every single quarter. Yeah, that's what I currently think about Kroger. However, as a time being, I'm staying away from this business because it's not in a price range that's interesting to me, and two, the biggest thing for me is the share dilution and debt to equity not being where it has to be. I'm not a huge fan of the score. I'm not a huge fan of the price, so it's a no from me. Anyways, folks, if you found this video helpful and you haven't done so already, hit that like button and subscribe button. I will see you in the next video. Thank you so much for watching. Make sure to check out all of my other analysis videos found in one of these lovely boxes that will appear on the screen. And I will see you in the next one. Thank you.